Okay, hello everyone, and welcome to this Cañada Blanch lecture series with the Governor of the Bank of Spain, Pablo Hernández de Cos. It's a pleasure to have you here. I'm Andrés Rodríguez Pose. I am the Princesa de Asturias chair here at the LSE and the director of the Cañada Blanch Center, which is also the center for all of you if you want to join at any time. I'm going to introduce Pablo Hernández de Cos, and then we have this great privilege because it's not easy to get central bankers to come and talk anywhere. It's not easy to get central bankers to come and talk at universities, and it's not easy to get central bankers to actually come and talk without any format. So he's going to be presenting, and then there are going to be questions coming from the audience, and that is rare. But I must say that with Pablo, everything has been very, very easy. So I hope that you'll be preparing your questions, sharpening your knives in a nice way, as this is the tradition here at the LSE, and we'll have a very interesting conversation. But let me just introduce Pablo Hernández de Cos first. Pablo Hernández de Cos is the governor of the Bank of Spain, and he's a member of the governing and general council of the European Central Bank. He's chair of the Basel Committee on Banking Supervision and of the Advisory Technical Committee of the European Systemic Risk Board. He's a member of various European and international committees, including the ESRB, the Financial Stability Board, the Bank for International Settlements Group of Governors and Heads of Supervision, the Advisory Board of the Financial Stability Institute, and the Center for Monetary Studies in Latin America. He's also vice chairman of the board of the Spanish Macroprudential Authority Financial Stability Board. Prior to his current position as governor of the Bank of Spain, he was Director General for Economics, Statistics and Research, the Bank of Spain. He headed its Economic Policy Analysis Division, and he worked as an advisor to the ECB's European Central Bank's Executive Board and as an economist at the Bank of Spain. He holds a PhD in economics from my alma mater, the Complutense University of Madrid, a degree in economics and business studies from CUNEF, and a degree in law from the Spanish Open University. But I think the words that would probably describe best what Pablo is when he became governor, I asked a friend of mine who happens to work at the Bank of Spain as a civil servant under him, how was the new governor? And I think her answer was very, very clear. I'm proud to work with someone who is always the best prepared in the room and who has the best command of all the dossiers that are discussed in that meeting. So
that's a friend.
Well, I didn't know whether she was a friend or not, or friend or foe, but she replied, and I think she said it from her heart. So that probably describes who you are. So Pablo, without further ado, the floor is yours.
Thank you very much, Andrés, for the nice words, and of course to Cañada Blanc and LSE. Well, you know, or you should know, students, I mean, that LSE for us, for economists, is a kind of a legend. So you are studying in a legendary school, in a legendary university. So don't miss the opportunity. Being with Andrés here at LSE, I thought that in order perhaps to have a proper and interesting discussion after my words, my initial introduction, one topic that could be of a lot of interest for you students is to focus on the future of globalization. And I guess it's obvious to everybody that the questions currently surrounding this topic are of the utmost importance, and in particular, I think it's of utmost importance for economies, and this is the case for the European Union, but also for the UK, that are highly open and integrated economies. And the motivation, I guess, is clear to everybody, but let me spend, before entering into the substance, maybe spend a few minutes also trying to put the focus on why, focusing on this topic. So we have experienced in the last 3 years 2 extraordinary shocks. First was the COVID-19 pandemic, and later the Russian invasion of Ukraine, which we all know they disrupted in a very significant manner global value chains and commodity markets. And they have generated, because I think we are still in this environment, an environment of heightened uncertainty and geopolitical tensions. And if you add this is the novelty of the last 2-3 years, but you should also take into account the past and present episodes of trade tensions between the US and China, among others. So that it's obvious, and if you read newspapers, it's obvious to everybody that these shocks have prompted renewed questions regarding the future of globalization and the increasing importance of geopolitical factors in shaping international economic relations. And I think this is a novelty, for many of us who have been in this business of studying economics and then being a practitioner as an economist. The fact that one of the main risks, if you read any financial stability report of any institution, including, of course, the Bank of Spain, you will see that the main risk, the first risk in the list, is geopolitical factors. Although the globalization of goods was slowing down even before the pandemic, concerns about the resilience of global value chains and the supply security of strategic products are now becoming more apparent, and are becoming more apparent in particular in decisions made by firms, but also by governments. And in particular, if I focus just for 1 second in governments, it's obvious that governments have become more concerned that trade and financial openness may create dependencies on third countries that increase the vulnerability, their own vulnerabilities to these geopolitical shocks. And accordingly, they are trying to respond to this new environment, and they have started to include geopolitical considerations in their economic decision-making with political initiatives that the main aim is precisely to limit such external vulnerabilities. And again, one element that I want to stress, as this is important for any country, but it's particularly relevant for countries that are such open as it is the European Union. And again, let me say that the European Union is probably the jurisdiction that is confronted with the highest openness in the global world. And let me put just one number. 2019, for example, the share of foreign trade in the euro area reached 54% of GDP. It was 31% in 1999. So there's been a significant increase in the share of foreign trade. Well, this is double the number in the US. In the US, this number is 26%. Let me give you another number. The share of global value chain participation in trade. This is around 20 percentage points higher in the euro area than in the US. And if you look at financial numbers, the euro area is again more financially open than the US, as measured, for example, by the stock of gross external assets and liabilities with respect to GDP. So meaning if we are more open, more dependent on international trade, of course, we have also to be more concerned about a potential risk of deglobalization. Okay, that's the main proposition I wanted to analyze today. So I will structure my presentation in 3 topics. Okay, the first one will be precisely to give you an overview of why I think Europe is particularly vulnerable. Okay, and I will be given some numbers on different elements of the European economy that shows these vulnerabilities. Then I will focus on the policy response, okay, and I will comment a bit on the autonomy strategy that has been followed by Europe, and I will add an element that for me, I don't know whether it's missing, but I think I'm still expecting to go into more deeper and concrete policies. And then I will put the focus on one specific issue of economic policies, which is monetary policy. Okay, because central bankers, we've been spending the last 10 years also analyzing to what extent the globalization process affected inflation or monetary policy transmission, or even the neutral interest rate, the concept of the neutral interest rate. So I guess it's obvious that we have also to try now to answer whether, if in the end we get into the globalization process, whether there will be symmetric effects to those that we found when we were analyzing the globalization process. Okay, and I will also make some comments on that. So let me start with the first topic. What are the main vulnerabilities observed as a consequence of the high degree of integration that Europe has? And I will mention at least four vulnerabilities. The first one is Europe's high external dependency with respect to some products which are key to the European Union economy, but which are imported from a handful of non-EU countries. So we are depending on these products, and it's not only that we are depending on these products, is that the exporters to Europe are a few, so only a few number of countries. Let me give you some very concrete examples. For example, China accounts for a large share of goods imports into the European Union, and in particular, China is the main exporter to the European Union of several electronic products, such as, for example, computers or optical devices. And the domestic capacity, domestic production of Europe on these particular products is very, very low. Okay. By the way, this situation is not unique of the European Union, and this is why some economists are applying this sentence or statement that China is becoming something like the OPEC of industrial inputs. Okay, which I think is a very good description of what we want to tell this domain. So this dependence on China's imports already, by the way, had implications, in particular, for example, in the first months of the pandemic. And there is already a paper published by the European Central Bank that is showing that Chinese supply chains disruptions during the first months of the pandemic had a considerable impact on manufacturing output in the European, in the Euro area in particular, temporarily reducing industrial production, manufacturing production in the Euro area by 7%, which is a material number. It's a very significant number. Another example is related to the European Union dependency on third countries for semiconductor production. And here, what we know is that European companies are involved in the manufacture of these products, yes, but they concentrate almost exclusively on the upstream stage of the production chain, okay? They provide manufacturing equipment and high purity materials used in chip production, but European companies account for an almost negligible share of other critical stages of the production chain, such as chip design, for example, or assembly. And again, here there is also, we are also heavily dependent on foreign suppliers. Almost 80% of the suppliers of European semiconductor companies are based outside the European Union. Another very, I would say, illustrative number. Third example, trade in energy goods. Trade in energy goods is, again, a prime example of concentration. One number, 2020, year 2020, the European Union imported 60% of its energy, with 4 countries, for example, providing 70% of gas imports, of which 40% came from Russia. Again, these 3 numbers, 60%, 70%, 40% are, again, very, very significant numbers. And of course, the consequences of this highly concentrated supply of key raw materials has been visible in the last year, after the invasion of Ukraine by Russia. So this is the current situation. What can we expect for the future? Well, it is true, in particular, if we want to focus on energy, that the transition to a greener economy will, in principle, entail a sharp reduction in aggregate energy dependence. This has already been estimated from around 60% today to around 10% in 2050 in a zero emissions scenario. So if we are able to reach to this zero emissions scenario, the consequence will be positive in terms of much lower dependency on energy. But, and this is important, this same policy, as by the way, also the digitalization of the economy, something that all governments in Europe are pursuing, will increase the European Union's need to import so-called critical raw materials. And let me explain why. These materials, for example, rare earths, that's probably the best example, but also palladium, cobalt are also other good examples. These are considered critical by, for example, in an analysis that was published by the European Commission, due to their economic importance, the difficulty in replacing them with other materials, and also by the high import concentration and other supply-related risk. And again, for example, China controls about half of global trade of rare earths and 80% of the refining capacity, okay, which again, they are very, very significant numbers. And another number, Russia is the European Union's main supplier of these raw materials, accounting for 18% of the total value of such imports in 2019. If you take into account this dependency today, with the fact that, again, if you look at this document that was produced by the European Commission, the demand for these critical raw materials would increase more than five-fold by 2030, because precisely if we want to achieve this zero emissions scenario, the one that I was mentioning before. So the message is, okay, we are currently very much dependent on these products, and it's true that if we are able to achieve the targets on zero emissions, this dependency will decline, but at the cost also of, at least if there is not a material change, also a high dependence on some of the products that are necessary for this to happen. So this is a more forward-looking perspective, let's say. Well, this is about imports, but don't forget also, this is second point, a second vulnerability, which is related to export concentration. And this is a key aspect for the European economy, because as you perfectly know, Europe has historically maintained a strong trade surplus. And by the way, this trade surplus and exports more in general have compensated to a significant extent the recent large terms of trade loss that has been due to the high energy prices also related to the war in Ukraine. And again, let me give you one example in this regard. European Union exports of various pharmaceutical and chemical products and some high tech manufacturing goods are highly concentrated, in this case, in the US and the UK, okay? And are also characterized, by the way, by also relatively low domestic demand. So it's not obvious that if there is a problem with these exports, this will be compensated, not in principle, with just an increase in domestic demand. This is something that at least I wouldn't take this as a baseline, you know, for a scenario. Third vulnerability, geopolitical risk could also have a bearing on the European Union's foreign direct investment and portfolio exposures. And here, well, it's true that you have to look at the numbers very carefully because it's not obvious how to get, you know, the degree of concentration of foreign direct investment and portfolio exposures. But again, the European Union's main investment partners are other advanced economies. But when you look at the data more in detail, you also see that in particular, when you take into account the origins of foreign direct investment into the European Union on an ultimate investor basis, we find that exposures with respect to the US, but also to China, are also very, very significant. And if I focus not on direct investment, but on portfolio or flows, what we see is that, in particular, the research that has been concentrating on restating holdings from a residence-based approach to a nationality-based approach, show that, for example, in the year 2017, the euro holdings of Russian and Chinese debt tripled when issuance via tax havens was accounted. Okay, so once that you take into account all the different elements that I mean are difficult graphs in the data, you find that there is also a significant concentration in these foreign direct investment and portfolio exposures. And then finally, a fourth vulnerability that I want to mention is related to geopolitical risk coming from the over-reliance of EU participants on non-EU players in this case, financial market infrastructures, and also on digital financial services. And here, again, there are several examples that are relevant. Let me mention a few. This includes the dominant position of non-EU payment-related services providers in intermediating European payment transactions. This is a very clear example. The over-reliance of European Union market participants on third country clearing services, and also the rapid rise of non-EU big techs and the complexity of this crypto ecosystem, which is dominated by few large crypto asset service providers, very often located outside the European Union. So in short, let me try to summarize this first part of the talk. The European Union, of course, like many other economies around the world, including the UK, faces a number of external trade and financial vulnerabilities related to our high integration into global value chains and high dependence on certain imports, exports, and non-domestic financial market infrastructure. Okay, that would be the main conclusion for this part. So let's now move to the second part. Before entering into the policy reaction of the European Union, let me try to give a brief overview of what is the interpretation that we are given to the most recent data. Okay, and it's not obvious because it's probably too early to know how and to what extent these new policies will affect globalization trends. But if I can summarize what the data seems to be showing nowadays, they seem to be shifting from dependence to diversification. Okay, now I will say a few words about this now. Second trend, from efficiency to security. And the third trend that might be observed is from globalization to regionalization. Okay, and let me give also to you some examples of these trends. So first, what we are observing is that companies are reducing their dependence on certain suppliers. So this idea of seeking greater diversification. Okay, which of course, I mean, they are doing this because they think that it is very useful in reducing the impact of global supply shocks, for sure. So there are already some surveys. You cannot see this in the data, but there are already some surveys that, for example, show that by the end of 2021, almost half of the companies had diversified their supplier base compared with only 5% that had implemented measures to return production to the company's home country. So it's not so much that companies are moving back, okay, their production capacities to their countries of origin, but what they are trying is to diversify, okay, which I think in terms of potential economic consequences, I think is better in the sense that this diversification may even imply or generate greater macroeconomic stability and even less volatility, at least if we are in a context or in an environment on which geopolitical risks are becoming very, very relevant and very frequent. Let me give you also more numbers. The European Investment Bank, they produce annually a survey, and the last was focused also on these particular topics. And what they found is that half of the US companies and 1/3 of the European Union ones have reacted already to the recent trend disruptions by focusing more on the domestic market. And there is another McKinsey survey on supply chain leaders worldwide, which basically finds that last year 81% of firms adopted dual sourcing strategies for raw materials, and the numbers in 2021 were 55%. So there is also a very significant increase in firms adopting this strategy. Second trend that I was mentioning is this move or change in priority from efficiency to safety. And here, a case in point, I would say, is the friendshoring. concept as a strategic objective in the case of the US, but also, for example, in the case of the European Union, Europe now aims to double its share of global semiconductor production to 20% by 2030. This is a good example of, in this trade-off between security and efficiency, we are putting more weight to the security part of it and maybe losing some efficiency, because it's clear in principle that this increased security is likely to lead to less risk-sharing capacity between countries, and also probably also to higher transaction costs. And the third trend is this one I was mentioning, moving from globalization to regionalization. And again, there is already some numbers here as an illustration. In 2022, 44% of global companies were developing regionalized supply networks, and the number for 2021 was 25%. So it was, again, the increase in this trend has been also very significant in just 1 year. So let me just now focus on what the European Union is doing. You know that the response the European Union to these challenges has been through the so-called open strategic autonomy agenda. And under this framework, there are basically 3 main policies or types of policies. The first is a set of measures that is basically aiming to assess supply chain dependencies and vulnerabilities and increase in the resilience of the European industrial system. I was already mentioned some of them. For example, this action plan on critical raw materials, which aims at reducing the EU external dependence in the sourcing of such goods. But I have to mention also the Repower initiatives, which main aim is reducing the EU energy dependence, or also the plans to drive the digitalization of European economies. This is one line of action. The second is a set of measures aiming to protect European Union countries from possible abusive practices adopted by third countries. Practices that may be related to a strategic or also to political objectives. And these measures include those aimed at monitoring foreign direct investment flows from third countries, and other measures designed to limit coercive actions against European companies. And then a third class of measures is aiming to preserve the international level playing field by compensating for competitive disadvantages that European Union companies might face due to less stringent environmental and stated policies implemented by third countries. And a very good example is, for example, the carbon border adjustment mechanism, probably the most important and relevant one among of the measures among this third type of policies. So what would be my main take from all this? Well, I think it's justified. I think the reasoning behind this change in policy in Europe is justified, and I think the policies might provide the results that are expected of their implementation. But it's also true, and it's related to what I was mentioning at the very beginning of the talk. What I see is also that if we want, in parallel, not to increase our autonomy, if we want to minimize the losses in terms of efficiency, because, I mean, there will be cost of the globalization process that we have to accept. But even also to ensure a more robust and resilient European Union economy, in my view, strategic autonomy policies should be accompanied by a substantial deepening of EU integration. So I see deepening EU integration as a kind of policies that could compensate, at least to a certain extent, okay, the cost of this deglobalization process. And here we all know that there are many issues to be done. There is being a lot of improvement, in particular in the last decade, but we all know that there are many also issues that are pending. So, for example, let me give just 2-3 elements that are pending. We need to equip the Economic and Monetary Union with a permanent macroeconomic stabilization capacity that we don't have. We have to finish the job on the banking union, and this has to be completed with the construction of a European Union deposit guarantee system. And for sure, we have to make progress in building a capital market union, which is absolutely essential to increase the resilience of the European Monetary Union to macro financial shocks, to better spread the cost of asymmetric or idiosyncratic shocks, and to reduce the risk of financial fragmentation and provide a more favorable environment to private investment. Okay, let me now turn to the third part of the talk before entering into the dialogue, Andrés, which is on the consequences of all these trends to monetary policy. And I think the question that could be raised is very obvious, are all these recent global developments relevant for the conduct of monetary policy? And precisely to try to answer this question, let me review the channels through which globalization may have impacted monetary policy, because as I was underlining at the beginning of the talk, we've spent, for example, in the strategic review of the European Central Bank, the one that was done between 2020 and 2021, and it was published and agreed by the Governing Council of the ECB in June 2021, we devoted a whole analysis to the impact of globalization and how this globalization might condition monetary policy. So let me just summarize what the outcome of this analysis was. And I will concentrate on three potential consequences of globalization. First one is on inflation, both in the dynamics of inflation, but also on the trends of inflation. Second, on the monetary policy transmission, okay? And then finally, on the interest rate, the neutral interest rate, no? Let's say the more structural concept of interest rate. So first, the evidence that we have is that, of course, in a context of increasing globalization, a number of global factors could impact inflation dynamics above and beyond domestic factors. So in very simple words, if we have economies that are now more open, we might think that inflation and inflation dynamics will depend more on global factors as compared to domestic factors. Okay, and there is evidence of this. So, for example, there is evidence that the impact of global slack on domestic inflation is positively related to a country's level of trade and financial openness. And therefore, there has been also an increase in the degree of synchronicity in the evolution of headline inflation. Okay. However, it's also true that these effects are found to have a small impact. They are not of a very significant nature. And it's also true that when you focus not on headline inflation, but on core inflation, so you eliminate energy and food, then this synchronicity almost disappears. Okay. And indeed, core inflation is less correlated across countries than headline, and cross-country correlations of inflation tend to be smaller at longer horizons. So it's also short-lived, let's put it this way. On inflation trends, of course, globalization could also affect inflation trends. For example, increased trade integration can impact inflation both directly by the fact that through higher shares of imports from low-wage countries. Okay, that would be an obvious way to reduce inflation and inflation trends, but also indirectly via higher competition, international competition. And again, the available evidence shows that this impact has been positive, but again, small in magnitude. And for instance, I can even be more precise, Eurosystem staff calculated that imports of goods from low-wage economies reduce Euro area CPI inflation through direct effects and increased competition, so the direct and the indirect effects, by 0.16 percentage points per year in the last 2 decades, although this was thought to be an upper bound. So it's material, it's a number, but it's not a big number. Let me now move to the potential consequences of globalization to the transmission of monetary policy. And again, globalization developments greater trade openness, wider involvement in global value chains, and accumulation of foreign assets and liabilities, broader dependence on international funding sources, or increased synchronization of asset prices could have implications for the transmission of monetary policy. And let me give you one example, which is also supported by the evidence, is that it shows that financial globalization has strengthened the exchange rate channel of monetary policy. Okay, and by the way, this has even more than offset the weakening of the interest rate channel through global financial cycle effects. More open economies experience larger valuation losses and wealth effects on their external balance sheets in response to an exchange rate appreciation. And this is mainly the result that is obtained with the data. Although, again, it's very complicated to look at all the channels, it's also true that globalization may have reduced the exchange rate pass-through to import prices. And again, this is mainly because of competition, international competition. And indeed, there is also evidence that this is also been the case. And then finally, another element that is being discussed in the literature, and I think is also very important, is the potential impact of globalization on the natural rate of interest. And here, again, this is also subject of a lot of debate and heated debate. On the one hand, one of the key determinants of the natural rate is productivity. One should expect that if there is an increase in productivity, there should be also an increase in the natural interest rate. And one also should expect that globalization, higher competition, should in principle lead to higher productivity. Okay, but at the same time, we also have evidence that financial globalization may have reduced the natural rate of interest by increasing global demand of safe assets. So there is a scarcity of safe assets, mainly because all emerging economies have entered into the financial world. Okay, and then this has generated a scarcity of these safe assets, and this has deepened the natural rate of interest. Which of these forces will prevail is, of course, difficult to say. So, one important element that is behind all these doubts that we have on whether, in the end, globalization has generated downward effects on inflation, whether globalization has modified the transmission mechanism of monetary policy, whether globalization has changed the natural rate of interest, is because it's not obvious what the impact of globalization is on in markets, on pricing behaviors, and on markups. Okay, and let me just spend 1 minute on this because I think it's important. So on the one hand, I think I've already repeated it several times, trade, participation in global value chains should, in principle, increase competition. Okay, but then there is also another part of the literature, and the most recent literature, that has been arguing that the interplay not only of globalization, but globalization, digitalization, and also the increase in the importance of intangible assets may give rise to high margin firms with considerable market power. And we've seen that this is happening in our economies. And this, of course, if this second element prevails, this, of course, will have completely different consequences for inflation dynamics, inflation trends, the transmission of monetary policy, etc., etc. Okay, so the question is, should we expect symmetric effects from a deglobalization process? And it's not obvious. I don't have the answer. That's the reality. But I would argue that there are several reasons that prevent us from assuming that this process is going to be symmetric. Okay, and I will give 5 elements to support this view. The first, I think it's obvious from what I said. It appears that the trends that we are observing are not fully consistent with a deglobalization process. Okay, but it's rather a change in the nature of globalization. So leading, I was mentioning, a regionalization of trade and supply chains, a diversification of sourcing, a certain, yes, a slowdown in global value chain fragmentation, but it's not a pure reduction in openness of our economies. It's much more complicated than that. And by the way, for example, the flattening of trade in goods is indeed and hints a trend or a slowdown in globalization. But at the same time, what we are observing is a continued growth of international trade in services, which this is particularly the case for technological products, and including, by the way, data trading and also the expansion of artificial intelligence. So, I mean, it's true that in some sectors, goods in particular, we are observing these trends with all these nuances that I was mentioning, but in other products, the trend in globalization remains, is still there. So that's my first point. The second is that the impact of these new trends, as opposed to a purely globalization or deglobalization trend, are far from obvious. And let me give just one example. So this offshoring concept. Well, it's true. Offshoring is usually related to job displacement, can justify even because of this. But there are several recent studies that highlight that it is also related to the upgrading of jobs towards more competitive and innovative varieties and to changes in employment composition in favor of high-skilled workers. So again, the idea is that it's much more complex than just to a quick look to the trends would imply. Third factor, well, it's also an element that it is important. It's about the timing. So the globalization process has been a process that has lasted for years and relatively in a slow motion. Okay, we don't know whether, if in the end we end in a deglobalization process, this could be very abrupt. For example, due to the start of a war in a place. And of course, then the consequences, the impact could be also non-linear. So not symmetric, as I was, it was the question I was trying to answer. 4th point, very important. Of course, the final consequences of this trend will depend crucially on the policies that will accompany the process. So it's of course not the same, and you should not expect the same consequences if this process is accompanied by protectionist measures, that it is accompanied by subsidies to domestic industries, or if it is accompanied by this concept of friendshoring, or if it is accompanied by investment, an increase in public, for example, investment that also leads to some private investment. The consequences of and the combination of these policies would lead to very different consequences. And then finally, and on this is probably the only thing on which I have more a strong view. What it is obvious is that this policy, what is creating, is higher uncertainty in general, and in particular, higher policy uncertainty. And of course, we know that uncertainty in general, policy uncertainty, is not good for investment. Okay, and I don't see in the next few years or the case that this uncertainty will decline dramatically, because it seems that it's here to stay. And of course, this is probably one of the consequences of this uncertainty, was probably one of the most obvious. So, what is my take of all this literature that I've tried to summarize on the impact of globalization on inflation, monetary policy, transmission monetary policy, etc., and the potential consequences of a deglobalization process? Well, it's true that these developments may affect the structural forces that shape the transmission channels of monetary policy and inflation, but given the elevated uncertainty regarding both the nature of these trends and also the implications of these trends, my policy conclusion is that monetary policy should not overreact to the potential supply-side effects of a change in the nature of globalization in the short run. But on the contrary, we should keep track of its long-run effects on the structure of the economy. Okay. In other words, I think that policymakers should act cautiously, and in the case of monetary policy, the monetary policy of the ECB, one of the key elements of the monetary policy of the ECB is precisely the fact that our price stability mandate, we define this price stability mandate as with a medium-term objective. So we are not trying to stabilize inflation at 2% tomorrow, among other things, because monetary policy cannot do that. Okay, what we are trying is to stabilize inflation in the medium run. Okay, so taking this also this attitude towards the potential consequences of globalization into inflation, into monetary policy transmission, I think is also the adequate one. And with this, I will finish, Andrés. Thank you very much.
Thank you very much, Pablo, for a very, very enlightening presentation. You've raised a lot of issues. You have not shied of making proposals. And now the way we're going to proceed is I'm going to collect questions from the audience, and Pablo is going to answer, but I'll take the first question. But while you're thinking your questions, please think that these have to be questions. So I will challenge all of you to start your question by how, what, why, to what extent, and finish with a question mark. We're not here to make statements, we're here to have a dialogue. And so I will ask you to stand up, state your name. If you are doing a degree at the LSE, which degree you're doing, where you're from, and then ask your question. But before I go into that, Victor is going to have to help me with the microphone there later on. I'm going to take advantage of my privilege as chair to ask the first question. It's clear from your talk that Europe cannot continue the way it was. There was a lot of words about reshoring, friendshoring, regionalization, deglobalization, that all driven by two fears. One is sudden shocks like the pandemic and the idea of trying to avoid the vulnerability that we had during the pandemic. And the second one was this whole idea of geopolitics, make ourselves less vulnerable in the face of war, like the invasion of Ukraine right now. But this has happened, and you mentioned it also, this is happening in a period of 4 decades at least of globalization, in which in that period, Europe has remained highly dependent on foreign energy. You mentioned the question of rare earth minerals and all other minerals. You mentioned semiconductors, which Europe produces virtually none. So they're all in Taiwan, they're all in China, in Korea, and Japan. And you also mentioned the whole idea that there has been, albeit in an indirect way, decentralization. What you're proposing is something which has been a dirty word for a long time, which is industrial policy. But we have deindustrialized, we probably haven't got the skills. So is Europe really ready for this deglobalization, this regionalization, this reshoring, this friendshoring in a world in which we have become so highly dependent from the rest?
Well, I mean, I don't know whether we are prepared, but we have to prepare. We have to be prepared. No, so we are in a completely different environment, and we think that this is a new trend, okay? And it seems to be that there are some signals out there that might justify this statement. Then, of course, Europe will have to react. And yes, true. One possibility is moving in this direction, no? That you were mentioning, industrial policies or whatever you want to name them. I mean, some of the policies that I have already mentioned that Europe is pursuing would be interpreted as industrial policy. Here, my message would be: okay, yes, this might be justified. Okay, the policies I was mentioning, but we have to be careful. Okay, because of course, governments are not always very good in trying to identify what is the best sector, industry that will be leading the future. That we know, and this is why we live in a market economy, on which the government doesn't play a very significant role. Okay, there might be now a justification to have a stronger role of the government on this, but we have to be careful that, of course, should be the private sector leading, okay, this trend. And then, on which I'm completely sure, I was emphasizing this very strongly in my presentation, and I will do it again here, Andrés, with this question, is that there is also a second avenue that probably is complementary. And on this, I don't have any doubt that it is good by itself, even in a globalized world. But that it can be particularly helpful in a deglobalized world in order to compensate, as I was saying, for the negative consequences of this process, is that Europe should be integrated more. And that's clear. And we are not. I mean, in many domains, look at energy markets. Well, the reality is that we don't have a single energy market. That even the structure of our economies in terms of dependencies of energy mix are very, very and significantly different one from the other, which might be justified for natural resources or even climate or whatever. This is okay, but I'm not saying that we have to lead to an homogeneous a structure of energy mix, but at least this energy, the energy that any of us produces, can fly to the rest of the country. That's one example. So in the end, deepening on the internal market, including, of course, the energy market, and all those elements that are what we call in Europe the governance of the European Union, that we know that are not complete. We know, I mean, not today. I mean, all the documents that have been written, the 5% report, and all the other documents that were produced in the last 4, 6, 7 years are claiming for a banking union, a complete banking union, for a capital markets union, for also a fiscal capacity as any other federal state has. So, I mean, the combination of these two things, I think, with this combination and the proper combination of these two things, I think Europe should be prepared.
Well, thank you very much, Pablo. So now, questions coming from the audience. Simona, you can start. Just state your name and who you are.
Thank you. Simona Iammarino, University of Cagliari, Italy, and LSE. Thank you. It was really great, inspiring. Just 3 words of background. I've been studying conflict minerals, but also critical raw material more generally for 5 years now here at the LSE. And as we know and we see, cobalt, lithium, gallium, molybdenum are key to AI and energy transition, because the main technologies that products are based on are actually intensive on these critical raw materials. So then what should Europe do? On the one hand, it seems to me a lot of research on alternatives and recycling, which, however, takes a long time, and we know. On the other hand, don't you think that instead of putting the rhetoric on deglobalization, maybe it would be good to say Europe as a champion of fair globalization, harvesting and harnessing, opportunities for both the EU and the developing country, first of all, Africa, for example, where this material are mainly concentrated? What do you think about it? I would be
No, I would buy completely your message, Simona. In the end, I think it's even a very intelligent way to go forward, no? Because in the end, we know it's not only that we don't have these materials that you were mentioning, it's also that there is a lot of concentration, a very high degree of concentration on the countries that are selling these products to Europe. So the idea of diversification, again, is important here. And if you combine this with the idea of also Europe trying to help other regions of the world in this concept that you were using, championship of fair and globalization, I think it would be a very good combination. And by the way, very much in the spirit of what Europe has always pursued. So I would completely agree with what you were saying.
There's a question over there.
Thank you so much. I'm Suryansh from ESCP, and I had a quick question.
Sorry, and the ESCB is?
Pardon?
You said you're Suryan from ESCB, and
yes.
the ESCB is?
École Supérieure something. It's a French university.
Okay.
And I don't know its full name. It's French. My question's on the lines of Ms. Simona over there. How would EU as a whole be sure that the cobalt and palladium and other natural occurring minerals in this world be sourced through fair trade and not slavery, and majorly looking at Africa? Because most of the cobalt, which is mined in Congo, has some sort of relation to slavery.
Yeah, well, I mean, among the 3 type of policies that I was emphasizing that were behind this strategy, that Europe is following, there was one that was precisely, I think it could be incorporated into this idea, okay, of avoiding to buy products from countries that do not follow certain rules. To a certain extent, for me at least, it's not very different to this discussion that we are having. What happens if Europe pursues, I mean, and I hope this is the case, very strongly for policies in order to meet our targets on climate change, but others are not doing the same. Okay, and we have already thinking about how not to put our companies in a very bad competitive equilibrium, because they should compete, or they might have to compete with companies in other countries that are not following the same policies. Well, why not applying a similar concept, but this time not on climate issues, but on social issues, which is I would say the generic name that I will give to the concerns that you and Simona had. How to do this? I'm not an expert, but I can imagine that this could be done. By the way, this shouldn't be very strange to us when we are talking about all the policies that we want to impose to private companies. We are referring, yes, to sustainability in terms of climate, but we're also referring to social. There is an S also on this SSD claims that we are trying to force to companies. Why not doing the same for governments? I don't think that this should be incompatible with the policy that we are currently pursuing. And in fact, I think it's important that this should be taken in very seriously.
Okay, if you go there to the back, there are quite a few hands now, so hopefully we'll get to everyone.
Thank you very much for your presentation. I'm Borja Ramirez from Citibank. You mentioned the need to try to get to close the European Banking Union. What is your view on the next steps? And also, if you could comment on the European banking consolidation. Thank you.
Well, on the second part of the question, it's clear that the consolidation of the banking system, at least if you look at the European dimension, is not happening. That's obvious, no? And there are several reasons for them. One probably is because the business case for this consolidation is much lower. So we know that one of the elements that incentivizes consolidation is the cost reduction. And of course, cost reduction is much lower when the initial position of the banks that might be merged or consolidated do not have any market that is common, which is basically the case normally in Europe. So this is, I think we should not forget this, no? Because sometimes we focus on the second part, which is of course the relevant one from the policy perspective, which is of course that, I mean, probably we are not with the current policy and regulatory rules, we are not incentivizing this to happen, at least not sufficiently. Okay, and this is on which we should focus from the policy perspective. But don't forget that if there is no an economic reasoning, a business case for this to happen, it won't happen. That we know. And then on banking union, well, I think we all know what is the missing part. The missing part is a deposit insurance scheme that is common. And for me, this is absolutely crucial for many reasons. But even for the political governance of Europe, imagine the current situation that we are facing. So we have banks that are supervised in Frankfurt, that if there is a problem, they are resolved in Brussels. But if there is public money that has to be put in order to facilitate the resolution, is the responsibility of national states. I mean, it doesn't make any sense. And of course, we all know that the fact that we don't have this common deposit insurance scheme is an origin in itself of fragmentation, of financial fragmentation. which of course for a policymaker that belongs to the central bank community, of course, that's a very negative factor, even for the transmission of monetary policy, by the way.
There was a question there at the back. So you go over there. So, Devita.
Thanks a lot for the wonderful presentation. My name is Devita, and I'm doing my master's in local economic development. So, so cost of living crisis is a big issue in the EU right now. And given that, wouldn't looking for more secure options or like trying to stop from being vulnerable to outside factors, wouldn't that deepen the cost of living crisis in the EU?
Sorry, I don't think I have understood. What was the initial part of the question? Sorry, and would you define the concept you want to?
So the cost of living crisis.
Cost of living.
Cost of living crisis has been a pressing issue in the EU. Given that, wouldn't looking for more secure options to not be vulnerable to the outside factors deepen the existing cost of living crisis, say energy, etc.? Because currently prices are increasing majorly, so wouldn't that just...
Okay, but since this is a dialogue, let's transform it in a real dialogue. What do you mean by cost of living crisis?
Increasing prices in general regarding energy. People have been protesting across.
Yeah. So the loss of purchasing power. Okay. Yeah. And then the question is?
The question is, if you're saying EU shouldn't, so you were mentioning how EU should be more secure and look for alternatives, say
Yes.
Energy, etc. Wouldn't that put more burden on the citizens, as in increase the cost of living on the whole?
Now I understand, sorry. Well, this is very much related to another issue that on which we central bankers are also very much focused, which is, I mean, what the potential consequences of, for example, climate change policies would mean for inflation. Okay, because I mean, you can think of the energy shock, the negative energy shock that we have suffered during the last year. Of course, this was for a bad reason. Was the invasion of Ukraine by Russia. But you can imagine a situation on which we take very, very seriously this climate change action, and you know, one of the instruments that would be more efficient for this is taxation. Okay, and taxation would lead to higher prices, energy prices, and this is precisely what you want. So what you think that there are certain activities that are creating an external, a negative externality, and precisely in order to internalize this externality, you set a tax. Okay, that is the typical textbook case for taxation. What the consequences of this for citizens will be? Well, they will have to pay higher prices for certain products. That's obvious. Okay, in particular, energy products, at least energy products that are generated by non-renewable energy, by fossil fuels, for example. That's clear in the short run. And this is why, precisely why, the political economy of the fight against climate change is difficult. Okay, because I mean, there is a price, at least in the short run. But, and I think this is what I would like to emphasize, which is, I think, also applicable to a situation on which you want to reduce the dependency on energy sources coming from abroad. In the medium and long run, it's difficult to define what medium runs exactly means. And for, again, in the political domain, this is very important. What we know is that renewable energy is cheaper. The only issue, which of course is very relevant, is that renewable energy, we don't have still the technology to make it disposable and available at any time because of storage, lack of capacity of storage, etc., etc. But I think we have to play and to emphasize that, yes, true, in principle, in the short run, these tax increases would in the end lead in the short run again to higher prices. There will be a change in relative prices. This is precisely what you want to generate in the economy. precisely for you and me to reduce the consumption of certain products, and also for producers to change completely or the production process or move to other businesses. Okay, and there is always a transition cost, but also with the mind and with the idea that in the medium or the long run, even at least in particular in the case of energy, what we know today is that renewable energy is cheaper. And if we put sufficient research, you were also mentioning, Simona, before in your previous question, well, in the end, that might be even more the case. So that would be my answer. But it's a very important question, by the way.
There are questions over here, so if you go over there. Good.
Hi, I'm Meta, doing geography economics at the LSE. So my question is, like, given an increasing dependence on the global digital economy, do you see having a digital currency like what China is doing with the digital yuan, or what Singapore is researching on and trying to codify money in a secure way as the way forward for central banks? Why or why not?
Well, the motivation for central banks, including, of course, the European Central Bank, to initiate a project on a potential digital euro, I would say it is twofold. No, one is more positive, and the other is more defensive. No, if I can use this word. Well, the first one is, of course, that what we are observing in all domains of our lives, but also in the use of money, is that well, the use of banknotes in particular is declining in many countries. Okay? And we don't know really this trend in the end where it will end. Okay, so it makes a lot of sense for the central bank to start studying whether there is we are in a position to offer an alternative that it is in digital format. Okay, and with the same, let's say, security, privacy, etc. elements than the current banknotes. And the second is, of course, that we are also observing that this crypto market, and in particular these stable coins that have been developed by markets, might at some point also compete, okay, with public money. Maybe not so much. This is not so relevant. This more defensive attitude for developed countries, okay. But I can imagine that in particular for developing countries or unstable countries, political instability, this could be dangerous, okay. So it makes again a lot of sense to try to study in principle the possibility, you know, of issuing a digital currency. We at the Aerosystem, we have initiated the project because what we want is basically to be in a position, if there is a need, we think, or the citizens think that there is a need for issuing a digital currency, to be technically in a position to offer. Okay, and this is why we have started the project. It will take a few more years. We are also observing and discussing with other central banks that are doing the same. But it's important to emphasize that we haven't decided yet to issue a digital currency. We will have to look at all these technical elements that are very complex, by the way, and we'll have also to have a business case to do so. And in parallel, we will have to be very sure, completely sure that issuing a digital currency is compatible with financial stability. So there are many elements there that will have to be considered before taking this decision.
Yeah, I'm conscious that there are quite a few questions also coming from the center, but we'll get there for logistical reasons. Your question now.
Thank you, Mr. Governor. My name's Mitali.
Can you get the microphone closer and?
Sorry, is this better?
Yes, yes. Be like a, I don't know, a singer. Just put it right next to your mouth, and it'll hear you strongly.
Okay, I will do. So thank you, Mr. Governor. My name's Mitali Thapa. I'm a senior risk analyst at the Bank of England and an alumna of LSE. You mentioned three key themes in terms of shifts towards diversification, security, and regionalism, and then further spoke about policy uncertainty. My question is, how do we ensure central banking regulation and supervisory policy is strengthened enough to navigate increasingly complicated cross-border jurisdiction of major financial players, yet flexible enough to encourage growth and innovation?
That's a simple question. So,
Well, I guess there were like two elements in the question, if I've interpreted you well. The first one is how to guarantee that we keep with financial regulation that sufficiently strong in all jurisdictions in order to guarantee financial stability. Well, I mean, in the end, well, you know that I'm chairing now the Basel Committee on Banking Supervision, and my experience chairing this committee has been very, very positive in the sense that, of course, I mean, in the end, it is the willingness of jurisdictions to agree and then to apply and to implement in full what we agree in the Basel, at the Basel Committee, what it is behind the fact that currently we have, well, very good, for example, banking regulation that has served us very, very well, for example, during the pandemic and also during the energy crisis. And probably the best way to guarantee this is to keep this international committees, this international agenda on which we are able to agree and then later to convince citizens that what we have agreed in these international committees is good, not only for domestic citizens, but also for the international community. And then the second part, my interpretation was that you were trying to try to make a trade-off between financial regulation and growth. No, and I don't know whether that was your intention, but let me, in any case, I don't think there is such a trade-off, in the sense that, I mean, to have a tough regulation, or let's not put an adjective to it. So a regulation that is able to guarantee financial stability in general, across the globe, is very positive for growth. We have already seen, and we have many good examples, and in particular, the last global financial crisis, of the consequences of having a banking sector or a financial sector in general that doesn't guarantee financial stability. And the consequences of this financial instability are particularly important for citizens. Are citizens, in the end, those who lose their jobs in those extreme and dramatic circumstances? Once again, the global financial crisis is the last example of what I'm saying. So probably it was not your intention, no? But so probably I misunderstood it. But for me, there is no trade-off.
the gentleman with the jumper here. So.
Hello, I'm Daniel. I'm a master's student in local economic development. And I want to ask a question regarding interest rates. If you think that this historic rise of interest rate by the European Central Bank is here to stay, or is rather a temporary solution, that these policy shifts will end up alleviating the weight on central bankers to use interest rates to keep inflation at 2%?
Oof, that's a very difficult question. No, of course, because in the end, it's also related to this discussion I was introducing in the last part of my talk, the third part of my talk, on to what extent globalization, but there are many other phenomena, no? Climate change, any other demographics, etc. In the end, whether they would lead to a higher natural interest rate. And it is true. I mean, before the pandemic, there was a clear consensus among economists that natural interest rates in all developed world was very, very low. Okay, and this was the justification for having very low interest rates in most developed countries. Whether the pandemic or the consequences of these geopolitical discussions that we are having in the end would lead to a dramatic change in natural interest rates, I think it's too early to say. So now we are focused on fighting against the inflation spike, and this is already, I would say, a very difficult job. At some point, of course, we will have to take a stock of to what extent all these developments are leading or not to an increase in natural interest rates. But I wouldn't try to give you an answer, because I really don't know. It's exactly the same or similar question to to what extent the inflation dynamics and the inflation and very high inflation environment that we are still observing, whether in the end this will lead to a move and to an exit from the very low inflation environment that we have lived before the pandemic. It's not obvious. It's not obvious at all. Because, well, it's true. I mean, if we enter into a deglobalization process, this might lead, I was mentioning, to a potential more high inflation environment. You might also think that the climate change might lead also to high inflation, at least in the short or medium run. But in the long run, that's not so obvious, as I was trying to answer before. Demographics will also play a role. I don't see there anything different to what I was observing before the pandemic, apart, of course, for the very dramatic consequences of the pandemic itself. So I don't know, at some point in time, after we've controlled inflation, we will have to come back to these issues and to really assess and analyze to what extent what it is happening in our economies in the last 3 years have really changed those patterns of natural interest rates or inflation. Now, I wouldn't be in a position to give a very clear answer to those questions.
Okay, I'm conscious of the time. There are a lot of hands. I'm going to already apologize to everyone that is not going to be able to ask a question, but despite the energy that you're demonstrating, Pablo has had a very, very difficult day, and we all want to end up by 7:30 or thereabouts. So there are going to be 4 more questions, and I'm going to ask them. They're going to come in pairs. There's gentleman over here, this man over here, this gentleman over there, and the woman at the back. And apologies to everyone else. So now 2 questions in a row that Pablo can ask. So if you can be brief, that'll be excellent.
We'll do. Moritz, my name, from MSc Finance and Economics. In one of your answers to the earlier questions, you mentioned that the digital currency would have to have the same standards of privacy as banknotes do. I imagine this being tough to implement. Do you think this is feasible? And if not, do you think this could pose an issue, or rather not?
Yeah, before you answer, if you can pass the microphone all the way to that man over there.
Thank you. Hi, I'm Neighbor Yu I'm doing the local economic development at LSE. And recently the Financial Times reported that the Argentina and Brazil are preparing for the common currency recently. So I was wondering what's your view of the future of this common currency, and what do you think the opportunities and the risks for the European Union and the globalization process?
All right, Pablo. Cryptocurrencies or digital
and
currencies.
I will also try to be brief so that the others also are able to make their questions. No, maybe I was misunderstood. This is very, very important. The privacy issue is very, very important, but this is one element that we have to analyze. So I don't have a final answer to this. Of course, we have to ask also to citizens what the requirements that they will have for a potential digital currency, and also we have also to take into account technology, to what extent this is feasible. Exactly what you were saying. So this is a very important question that we will have to answer precisely through the project. Okay, and then on the Brazil, Argentina. I don't know. I don't have the details. The only thing I know is what I've read in the news. Of course, for me, the European experience has been very, very good. But it is also true that the European experience was on a single currency was almost the last step of a process of integration that took many, many years, and that allowed to a great extent to have a common currency without, let's say, or eliminating or minimizing some potential negative consequences of this project. So what I would say that I think in the case of Argentina and Brazil, of any other alternative that might emerge, I think it's important to guarantee that the integration process is behind the potential introduction of a common currency is well developed, so that the economic fundamentals behind the single currency are strong.
Okay, please go ahead.
Yeah, my name is Victor Orte. I'm studying here at LSE, the Master of Public Policy, and thank you for your presentation. It was very, very insightful. I wanted to ask you on industrial policy. You mentioned that the answer to this kind of deglobalization is more integration, capital markets union, banking union, fiscal capacity. But it seems that the Commission is moving the way around. It's flexibilizing state aid rules and so on. So what do you think is that maybe an intermediate step that because it does all the capital markets and so on doesn't seem to be politically feasible in the short term, at least my perception. Is there any intermediate step that we can do that might help us sort of get to it? Thank you.
And if you can pass the microphone to the back. Yeah, you.
Hello, hi. I hope you're all doing
Can
well.
you get your microphone closer?
Hello, hi. I hope you're all doing well. My name is Adriana Mguni, and I'm here with Virtuous Grace and Lord Emmanuel. I wanted to ask concerning immigrants that are not permitted to work and the impact that it has on the economy, and what suggestions do you have concerning immigration? People are not permitted to work but desire to work instead of them relying on the state. Thank you very much.
Thank you.
Well, it's a difficult question. I'm not an expert on immigration, but let me put it in economic terms. No? What it is obvious is that Europe is aging. Population growth is, the trend is clearly on a downward path. And that this is one of the reasons why when we estimate the potential output growth of the European economy going forward, we get lower numbers. Okay, this is affecting the economic growth and will affect economic growth in the future. And of course, one possibility in order to compensate for the domestic and national dynamics of demographics is by increasing migration. Okay, and I think the experience of Europe over the last decades has been very positive in this regard. Of course, there are always issues of integration, in particular labor market integration of immigrants that are crucial in order precisely not only for these positive effects in terms of growth, but also for social cohesion that are absolutely relevant. But I think that Europe should be in a position to manage those challenges. Okay, so migration will remain a very important topic. I'm pretty sure in the next decades for Europe. And then on the first question, I don't know. I'm not sure that I have a quick win. Okay, my point was, okay, we are entering into this new world, okay, of trying to gain more autonomy, less dependency, more diversification. This is completely new for us. Okay, 3 years ago we were not discussing this on this topic. Or at least the strength of the discussion now is very high. But let's not forget that there might be efficiency cost of this deglobalization process. And I'm not saying this is not completely justified what the European Commission, the European Council is putting on the table, but precisely in order to compensate for some of these potential consequences, don't forget that we have still some steps to go in terms of integrating our economies. And this can be seen, or should be seen, in my view, precisely as an element to compensate for the potential cost. And if you want a rank of the 3 elements I was mentioning, the 3 of them are very relevant. The 3 of them, capital market unions, absolutely crucial. So Europe is an economy that if you compare it with the US, for example, there are 2 main differences that are very negative for the European economy. The first one is that capital market-based financing is very low. And the second is that we don't have a unique and a single capital market. There is fragmentation. In the end, these two factors are affecting negatively the capacity of the investment capacity of the European Union. And with banking union, I was referring to it previously, exactly the same, or with a fiscal capacity. I mean, of course, during the pandemic, European governments were able, in a very dramatic situation, to agree in a few weeks to an instrument with NGO funds that was able to compensate for the fact that we don't have this fiscal capacity. But I think it will make a lot of sense to have already a design that it's stable and that, I mean, there is not a need for an agreement in the middle of a crisis, which is always very difficult. And again, all federal states have similar instruments and similar mechanisms. Why Europe is not having one? The three of these pieces are relevant. Of course, I'm conscious that in terms of, I mean, it's not easy politically. We know that, but I mean, I don't think there is on the contrary, I think there is now a new reason to not only to start this debate, because the debate started many years ago, but to be concrete in terms of the policy outcomes.
Okay, thank you very much. I'm going to take my prerogative as chair to go back to something you said and ask you if you allow me a slightly more political question as a final question. You emphasize very much in your presentation and then in the answer to my first question, the need for greater European integration. But let me just be a devil's advocate. How feasible is that in a Europe where Eurosceptic vote has gone from 6% in 2004 to 26% last year, where we have three countries, Italy, Poland, and Hungary, governed by clear Eurosceptic parties, and where we have lost one country to Brexit and their threats or potential threats that this might happen in other parts of Europe?
I think it's feasible. I think it's feasible. I think I don't think we have to be pessimistic on this. Referring to also to the question to the last to my answer to the last question, we already the European governments gave a unique and extraordinary response to the pandemic, and it was a unique response. Why in a also very complex context, or extraordinary context, on which we all know the solution, the optimal solution for Europe to give is more Europe. I mean, there is none of the challenges I was mentioning in my talk at the beginning that could be optimally answered individually by European. None. Give me one. None. So in the end, if this is so obvious for all of us, then press our governments to do what we want to do, which is to have a deeper integration in Europe.
Okay. Thank you very much. And I'd like to end up on a positive note. Pablo, it's been a real privilege to have you here and to have you in an open, frank conversation. I told you, some of you at least, that central bank governors have to measure their words, because whenever they say something, a lot of economic things might happen and a lot of the cost of living may rise or may go down. Having someone like Pablo Hernández the Cost come in here and having unfiltered, completely unfiltered questions is very rare, and I think we are very lucky to have him here. You're welcome anytime you want to come here. And remember, first, I think we should then again thank him in the usual way, because I think it has been absolutely amazing. So many thanks, Pablo. And for all of you here, remember that the Cañada Blanch Center at the LSE is not finished. This is the second event we have had this week, the fourth this term. There'll be two more events coming before the end of the term. We'll have the fellows presentation that will take place at the beginning of the month of March. Then we have the first vice president of the Spanish government, Nadia Calviño, coming on the 31st of March at 3 o'clock. And that will be followed in the spring by the Cañada Blanch Forum in lovely Valencia, which is going to be very much related to what you're saying, which is mainly about investment and also about global value change global value chains and the change in global value chains. And we're going to have a virtual event in early May, I think is the 10th of May, 11th of May, dealing with the development and the regional development trap in Europe and across the world. So please follow us on Twitter, on LinkedIn, on our YouTube channel. And to those of you here and to those of you following us live, many thanks and see you at the next event. Thank you very much. And thank you very much, Pablo.